let's start with our market panel now. Joining us now is David Zervos from Jefferies and Brooke May from Evans May Wealth. Guys, happy Friday. Brooke, I feel like maybe there was a narrative shift this week. If you were defensive, if you thought things were imminently broadening out, you were disappointed. But some people might think, surely now the big gains are done. You say they're not. So what takes us higher?
We think that earnings take us higher. When we look at the S&P, we put a 5,200 to 5,400 price target on it between now and year end. We've had that price target for a few months, so we got some pushback initially, but now we're 2 to 6% from that target. We're not opposed to revising it, though, if we see earnings come in better than expected. And so as we look at not only Q4, but Q3, earnings weren't the debacle that a lot of people were expecting. And now that we've seen most companies report, earnings beats were in line with the 10-year average. So the economy isn't doing as poorly as some thought it would, and we think that'll continue. Okay, and David, the 10-year yield has been quietly marching higher all month, now above 4.25. What does that, if anything, portend for equities?
I think, John, markets just really priced out a lot of these rate hikes early that were priced in the beginning of the year. If you look at the moves in some of the projected rate levels for March or June, they've moved 60, 70, 80 basis points even to start the year. So pretty incredible. The long end has stayed pretty intact. The curve's inverted a little bit more, which I think is healthy for the stock market because it's just saying, look, we're going to stay at that 5.25 to 5.5 range a little bit more, but we're eventually going to get some what I like to call victory cuts as the victorious Fed wins the inflation battle. And I think that's, a story that's still TBD, but certainly with 600 basis points of disinflation over the last 18 months or so, they've done a heck of a job compared to where many thought they would be. And I think that's the reason the market continues to do pretty well, is that long end, even though it's marched a little bit higher, has found some equilibrium here, I think, this week a little bit, especially today. It felt pretty good.
Yeah, Brooke, that raises a key question, and that is, in a week where we saw the S&P, the Dow Industrials, the NASDAQ 100 all reach new record highs, propelled largely by NVIDIA and this AI halo effect we've been talking about and what it's done for tech stocks more broadly. Is that what matters the most to the market right now, or do we have to set our sights back on the Fed and what rate cuts look like this year amid a flurry of Fed speak we've gotten this week, and now expectations that whenever we do get a cut, it's going to be later than the market was expecting?
As we've seen for the last year, the bond market's been tethered to the Fed, and the stock market was tethered to the bond market. That's now no longer the case. There's some decoupling that's going on there, and we're able to kind of step back and look at where are earnings. And inflation, it definitely has an impact. Higher interest rates definitely have an impact, but we see that easing. We're in the camp that rates aren't going to be coming down until the second half of the year. But when you peel back the onion and look at CPI, 30% of CPI is shelter. And the way shelter is calculated, there's a little bit of a delay. So when you look at real time, rents are going down, and that's going to feed through to CPI, and we're going to start to see some cooling here in the months ahead. So while it appears sticky, there is some light at the end of the tunnel. And once we see that those rate cuts are imminent, the stock market's going to go higher, and it could go meaningfully higher.